On May 7 and 8, the rupee slid around 1.5% to roughly 85.7 per dollar, and the Nifty 50 index fell 0.6%. The Indian markets were jolted by the May 2025 border clashes. The rupee saw its worst drop in a month amid rising war fears. Trading volumes spiked and volatility saw multi month highs. As Sandeep Bagla, the CEO of Trust Mutual Fund, puts it, investors reacted in a knee jerk fashion to rising border tensions. In practical terms, this global uncertainty drove money into safe haven assets like gold and prompted selling in assets like equity. These immediate swings show how quickly fear can bite the markets when geopolitical clashes flare up. Hello everyone, welcome to my channel. I'm your host Avni and let's quickly begin. In this video, we will break down how governments get money for wars, what usually happens to economies afterwards, how families feel the impact, and crucially, what steps you can take now. With clear data from past geopolitical clashes and expert insights, we'll help you weather this storm without panic. According to history, to pay for sudden jumps in military spendings, the government used three main tools. They can raise taxes or cut spending, which frees up cash for defense, or they can borrow money by issuing government bonds, or they can create money, which is either by printing or monetizing debt. In practice, many countries favored borrowing plus limited tax hikes. Taxes are usually considered the most economically efficient tools for raising money because they raise immediate revenue without long term debt. However, governments fear that raising taxes might lead to them losing support on war initiatives. Borrowing, which is selling government bonds, is easier in the short term because it lets today's expenditure be paid for by tomorrow's revenue. But it adds to national debt and interest cost in the future. Printing money, also known as fiat creation, is the most inflationary choice. History provides cautionary tales. During the US Civil War, the Confederacy printed so much currency that the prices climbed roughly tenfold. And after World War I, the US saw a sharp inflation spike when the Federal Reserve monetized government debt. Any war budget will likely involve a mix, some higher taxes plus shifted spending, and a little bit of borrowings. These moves boost aggregate demand in the short run, fueling growth and inflation. But in the long run, the funding choices matter a lot. Debt and inflation can burden economies when hostilities have ceased. Once fighting stops, economies usually go through a dramatic readjustment. The immediate effect is rising inflation. With wartime rationing lifted and factories refitted to consumer goods, demand surges. History again shows this clearly. After World War II ended, the US inflation rates rose 20% in just 1947 as pricing controls were lifted and people unleashed years' worth of pent up savings. In peacetime, consumers rushed to buy what was scarce, pushing prices up. At the same time, the huge military spending that was boosting the economy dries up. This shift can cause a short term boom and then slump effect. Industrial output pivots from planes and tanks back to cars and refrigerators, and overall growth falters until the economy rebalances. The key takeaway is that wars often lead to a temporary jump in inflation and a reshuffling of economic activity. Inflation and uncertainty quickly transform into household pain. In practical terms, families might see food, fuel, and utility prices spiking even before normal supply chain is reestablished. Middle class and fixed income families feel this the most. Their salaries don't increase immediately, so each rupee buys less and less. People often react by cutting non essential spendings and dipping into savings, which adds to the stress. Moreover, jobs and market uncertainty can cause anxiety. Investors panic sell, and ordinary people worry about layoffs or stalled raises. In short, conflict driven inflation erodes purchasing power and increases financial strain, which makes money management even more essential. It's not just wars or geopolitical conflicts, crises are aplenty. Be it global crisis like the COVID-19 pandemic or a local one like the devastating Kerala floods, or your personal medical emergency. Financial shocks are inevitable, but the right strategies can turn you from victim to survivor. So let's break down some universal money rules that work for any crisis. The very first and perhaps the most important, your first line of defense is building an emergency fund. Aim to save at least 3 months worth of expenses in cash and 6 to 9 months worth of expenses in highly liquid assets like FDs. Also, keep a buffer for any tax hikes or unexpected inflation. A healthy emergency fund means you can cover unexpected price hikes or temporary job loss without going into debt. The second is insurance check. Read the fine print on your insurance policies. Most policies do not cover acts of war. Only 17% of the health plans in India cover war related injuries. Review your policy, make sure you understand the exclusions, update your nominees so your family can access benefits if needed. Being proactive prevents financial strain during times of crisis. The third is revisit your budget. Track your spendings closely, prioritize needs that is food, medicine, rent, and cut down on discretionary spendings like eating out or watching a movie. Holding off on non urgent large expenditures also helps you keep flexible. The fourth is cut high interest debt. Central banks usually raise rates to curb inflation caused by conflicts. So, higher interest rate borrowings like personal loans or credit cards can become burdensome. If possible, pay off your expensive debt now. Lowering your debt obligations ensures that the effect of rate hikes on your budget is minimal. The fifth is diversify into inflation hedges. If you're an investor, allocate a portion of your portfolio to assets that are known for holding value during inflationary periods. Gold, of course, is the classic example. I've created a video on gold and how to think about investing in gold. I've linked it here. You can click on the I button and access it if you are interested. And last, but the most important, stay informed but don't panic. Markets often overreact to news in the short term, so a measured response from you is the key. Impulsive decisions like panic selling investments usually backfires. Stick to your plan, review it rationally rather than taking emotional decisions. These basic principles are for everyone, and if you're not already following these, crisis or not, start today. Save first, spend smartly, and cut unnecessary risks. This mantra will help you safeguard your financial interests in any situation. Now, war also comes with some opportunities. So, for more experienced investors who want to capitalize on these and can take on more risk and complexity, here are a few more strategies. First, maintain some extra cash or liquidity if you can over and above your emergency fund. This gives you dry powder to buy quality assets at lower prices. Using volatility in this way is 100% optional. It requires a great deal of discipline and market timing, but it can substantially boost returns if you can gauge the bottom correctly. The second is consider global or hedged exposure. If you have access, you might hedge currency risk or invest internationally. A decline in rupee versus dollar is highly likely in conflict situations, so some investors hold small foreign currency or USD denominated assets. Similarly, diversifying outside India can reduce concentration risks. But keep in mind, this is an advanced move because currency or geopolitical hedges add an extra layer of complexity. And the last is sector rotation. Certain industries reliably outperform during conflict situation. Consumer staples like food, healthcare, household goods, and utilities usually hold steady, while defense or aerospace stocks often rally driven by higher military budgets. For example, defense stocks like HAL rose about 5.8% post Operation Sindoor. During the Russia Ukraine war, Lockheed Martin rose about 35% in 2022. Raytheon also gained about 25% on increased NATO spending. Advanced investors might think about overweighing these sectors in their portfolios with the help of ETFs or individual stocks. But of course, this strategy is highly risky and is extremely dependent upon timing both entry and exit into the ETF or the stock perfectly. So before you start investing, size these positions carefully. These advanced tactics are not for everyone and assume that you have market know how and can bear short term volatility. Use them only if they fit your long term plans. And always keep some core safe holdings as well, like bonds or cash. And again, to reiterate for everybody, maintain a healthy emergency fund and do not sell in panic. For example, post Kargil, the Sensex surged about 20% in just 6 months. Or more recently, the Nifty 50 surged 3% on May 12, 2025 after de escalation news. Bottom line, markets have survived wars, pandemics, and crashes. And like Warren Buffett says, the stock market is a device to transfer money from the impatient to the patient. Wars test resilience, but history favors the prepared. Always remember, markets are resilient. The Jeffries team has summarized it really well for us. Any major corrections are short lived when viewed against long term trends. In the medium term, focus shifts back again always to fundamentals. When tensions ease, investors go back to looking at GDP growth, corporate earnings, and trade talks. For example, the one between UK and India or the one between China and US. In short, peace and stability remain the ultimate drivers of value. But what can you do right now? Even though the Indo-Pak tensions seem to have subsided, you should start today. Follow the plans above calmly, stick to your emergency fund, make graduated adjustments rather than panic moves. Every small step adds up. If you're an advanced investor, use those specialized hedges judiciously during times of crisis. But do not gamble more than you can afford. And most importantly, keep perspective. Economic fundamentals do not disappear overnight. If you liked this breakdown, stay tuned in for more such insightful videos. Give me a thumbs up and share this video with your friends and families. Also, don't forget to subscribe to my channel and press the bell icon so you never miss any new releases. Stay safe, stay savvy, and I'll see you in the next one.